How do you expect China to do in 2012?
Again, I would say that I would expect it to fare much better than it did in 2011. I think the inflation amelioration trend that I spoke about really gives the authorities room to ease. While we don't expect a major new imminent credit cycle, an unleashing of a major credit cycle to delay the day of reckoning that many fear in China, we expect the possibility of a hard landing to be pretty negligible. We're looking at about 8% GDP growth. We may be at sort of a trough or a low point in terms of the actual quarter-on-quarter growth in the current quarter, because China today is experiencing both an export slowdown, EU being the biggest market for the Chinese economy, as well as ongoing adjustment in the real estate sector. But our perception of the Chinese ability to handle this downward risk in the economy has improved. And I think you see a lot of speculation on China hard landing. Just the fact that the headlines on China implosion and China time bomb are receding counts for something in my view.
You think those concerns in the very first place were overdone?
Look, there's a basic law in economics that speed of growth and the number of accidents are correlated. And what's going on in China has been growing at 10% per annum for the last decade or so. So far, it's violated that law in that you haven't seen an accident. And so there's a camp in the market which believes in systemic misallocation of capital and a hard landing. I have no doubt that a few years down the road, 3 to 5 years down the road, Chinese growth rates are going to collapse. But we don't have a good signal today as to when things will blow up. We have to recognize the limits of our knowledge in terms of being able to predict that. And at this point, I feel quite comfortable being long China. And we're already seeing from the PBOC, targeted fine-tuning in terms of easing. Money supply was very, very tight in China. The Chinese stock market actually trades as much in liquidity as it does in growth. And money supply, after hitting a 3-year low, has accelerated back again. Bank lending is surprised on the upside. Property prices are correcting. They're already down high single digits. But to us, this doesn't sort of translate into a hard landing scenario. We are sanguine, on a 1 to 2 year view, and we're cognizant of the risks there. But at this point in time, I think the authorities are showing they have the economy under control.
So what are your broad calls across the region at a country level as well as sector-wise?
At a country level, the portfolio favors, at a market level, India, China, and Southeast Asia. These are the 3 core sort of big allocations that we're running currently. China, as I outlined to you from a pure valuation perspective, as well as the easing cycle, the RRR cuts in China have already begun. We like the industrial space in China, we've liked the financials, and we like consumption stocks in China. In India, with the ebbing of the interest rate cycle, we are raising our beta, which we had tempered all of last year, where we were more sort of, playing IT stocks, global technology stocks. Now we're tending to favor more interest rate sensitives. The caveat emptor on India, if I may say so, historically we've always liked the quality of private sector companies in India, because you get a very good sample of professionally run high quality companies who have an empirical track record of delivering shareholder value.
But there's always that concern in corporate governance. You think that has gone
in fact, in corporate governance, India is quite polarized. There's a section of the market which is extremely good. In fact, you don't get that quality of management and that you do in India, because India has a long history of managing publicly quoted companies. It's the oldest stock exchange in Asia. You don't see it in China, where most companies have emerged out of the state sector. It's improving, but we don't. But in India, I think it's been very polarized, and companies which have shown corporate governance question marks, or what I call in the sin bin, have really been derated and have almost become no-go kind of, parts of the market, irrespective of, the delta or the improvement in operating fundamentals. And we, by and large, like our sleep at night factor and tend to steer away from those companies. So in India, beaten down interest rate sensitives, but also on the lookout for, high quality, high growth consumption stocks. A lot have got hit. I mentioned Maruti is one of them. Footwear retailing, Bata is another stock that we like in India, which to us is, a near staple type of consumption, but growing at 25% per annum in India. So select opportunities in the consumption area and in interest rate sensitives. Less positive in Indian IT now, which we liked in an Indian context, not an Asia ex-Japan context. Then I think in terms of, we've raised our cyclical exposure. Energy for us in the commodity complex is a preferred sector. A, it's a hedge against geopolitical risk, which with the developments in Iran has been intensifying. B, I think, look at the global environment, despite the global financial crisis of 2008 and the downturn that you saw arising from the European sovereign crisis last year, oil prices have been very resilient. And this is to do with the fact that the marginal cost of oil is rising. Despite the huge amount of expenditure in exploration, you haven't really seen non-OPEC supply increase that much. And at the same time, emerging market demand continues to be very strong. Emerging markets consume, as I'm sure you know, more oil than developed markets today. So oil is a very good tail risk hedge, both against geopolitics in the Middle East and gives you an element of moderate cyclicality. So we are overweight energy stocks across the region, and we've recently made forays even in the Indian energy sector.
Which pocket of energy do you like in India? I mean, do you like the exploration side? Do you like the marketing side of the business, which is, of course, government-related and government-controlled? Or are you looking at, some of the mining and mineral sectors as well?
And the answer is all three. We're looking at Reliance, and we're looking at, mining and mineral sector as well. The marketing stocks, I don't think are masters of their destiny in India because, it's not a deregulated environment. So at this stage, we haven't visited those, although they remain very well-run companies. But basically, we're looking at Reliance and the metals and mining stocks. And as I mentioned earlier to you, this coordinated easing and unlimited provision of liquidity, including zero interest rate policy till 2014, as against earlier expectations of mid-2013, is a positive backdrop for energy and commodity stocks globally.
And in financials, since you mentioned that's a favored sector, are you concerned on the asset quality side right now? Or, is the value aspect more lucrative to get you into those stocks?
I think we would temper our enthusiasm from a pure valuation perspective. The Indian state-owned banks had, gone down to distressed valuations. But I think the whole, acknowledgement of the NPL cycle, which is yet to kickstart, is a positive step in my view. The power sector bailout, now with the government getting behind resolving fuel, coal linkages, as well as, the whole state electricity board finances moving in the right direction, is a slow process of resolution that we expect and hope will be resolved this year. But I would say that the risks are mixed there, and certainly for all of last year we've been backing banks which do not have those asset quality risks. And we're not gung-ho bullish, but we're increasingly more constructive as we think that those asset quality issues are to a degree discounted in prices today.
What about infrastructure and capital goods? Because you like those stories in China. Do you fancy them in India as well?
Historically, we have not been big believers in that space. We think that minority shareholders haven't really made that much money in these sectors, despite the theme being, of course, a multi-year one. Many of these companies on our bottom-up work don't generate cash. Cashless earnings has been sort of a characteristic in Indian infrastructure, which is a predictor of poor future equity returns. Were that to change, and were you to really see deleveraging of the balance sheet and better earnings to cash flow conversion, I would turn more positive. Also, I think this is the one sector where corporate governance has been less than satisfactory. So given our focus on corporate governance, which we believe has a major impact on stock valuations, we have steered away from this sector in this particular strategy that I'm referring to. And if you look at the last 2 or 3 years, even in the Indian bull market, these have not been long-term money-making opportunities. We are much more sanguine on Indian consumption, where we see secular tailwinds there.
So finally, Nidhi, are you going to be looking at the second half of this year, giving out better news for Asian markets and India in specific, given that the first half would be defined by a lot of event risk?
Well, I would disagree, and I would say that people might be surprised in terms of the first half, actually turning out to be better than most market participants expect. Sure, there will be volatility. We're not out of the woods in Europe. Greece is sort of, surely but surely marching towards an orderly default, we hope. So you will see volatility, but I would expect, a better first half, certainly than the last quarter and the second half of 2011, when Asian markets were really smashed, for basically global macro reasons. And were systemic risk to really, recede, and were we to get a clear signal that tail risk is now down to zero, we would be then getting very, very bullish on Asia ex-Japan. That's what holds us back from getting, fully invested today.
All right, Nidhi, thanks very much for your time. Well, with that, we come to the end of this edition of Global Mantra. Thanks very much for watching.